Welcome to The Explainer. Today, we're going full detective because we're on a mission to crack one of the biggest mysteries in the entire world of finance. So, what's a company really worth? You see that stock price flashing on your screen all day long, right? It's up, it's down. But here's the thing. That number, it's basically the market's mood ring. It just tells you what people are willing to pay for a tiny piece of that company right now. It's a huge clue for sure, but it is not the whole story. And to really solve this mystery, you've got to get your head around two totally different concepts. On one side, you have that market price we just talked about. That's the crowd's opinion changing minute by minute. But on the other side, you have intrinsic value. And that, my friends, is the real prize. It's what the business is actually worth, deep down, based on its raw power to generate cold, hard cash. Okay, let's dive into this. So where does any good detective start? You gather the evidence, right? For us, that means we're cracking open the books. We're digging into a company's financial statements. You can think of these as its tell-all biography, just, written in numbers. We're going to look at the big three reports that, when you put them together, spill all the secrets about a company's real health. First up is the income statement. This is basically the company's report card for a specific period. It answers one simple question: are we profitable? It takes all the money coming in, subtracts all the costs going out, and boom, there's your bottom line, the net income. This is where we find out if they're actually making any money. Next up, the balance sheet. Now, if the income statement is like a movie showing what happened over a year, the balance sheet is a single photograph. It freezes a moment in time and tells us, okay, on this one day, what does the company own and what does it owe? And that little bit left over, that's what belongs to the shareholders. And finally, we have the statement of cash flows. Now, this one might be the most important of all. You know the saying, profit is an opinion, but cash is a fact? Well, this statement follows the facts. It's like a GPS tracker for every dollar, showing exactly where cash came from and where it went. A company just can't survive without it. But here's where it gets really clever. These documents aren't just three separate files in a drawer. No, they're all interconnected, telling one big story. That net income number from the income statement, it's the starting point for the cash flow statement. And that same profit, if it's not paid out, gets added to the balance sheet. See, it all fits together like a puzzle. All right, so with our evidence in hand, our investigation now turns to a fundamental rule of the road for the entire financial world. It's a simple trade-off, really, but it changes everything when you're trying to figure out a company's value. And that rule is all about risk versus reward. But here's the key thing to remember. Not all risk is the same. The market only rewards you for taking on risks you can't get rid of. Things like a factory strike or a new competitor, you can manage that by owning lots of different stocks. That's called diversifiable risk. But market risk, stuff like a recession or inflation that hits everybody, you can't escape that. And that's the risk investors demand to be paid for taking. Which brings us to this little thing called beta. Just think of beta as a stock's personality score when it comes to market risk. A beta of 1 means it pretty much moves in lockstep with the overall market. If the beta is over 1, it's more volatile. It'll jump higher when the market's up, but fall harder when it's down. And if it's less than 1, it's more of a steady eddy, less bothered by all the market drama. Okay, so we've got our evidence from the financial statements, and we understand the rules about risk. Now it's time to open up the detective's toolkit. We're going to look at the two main methods analysts use to turn all this info into an actual number for what a company is worth. The first tool, and the one all the finance pros love, is the discounted cash flow model, or DCF. The idea behind it is actually beautiful in its simplicity. A business is worth all the cash it's going to produce from now until the end of time. The hard part, of course, is guessing what that future cash will be. Once you have your forecast, you then discount it back to what it's worth today. Because, a dollar tomorrow is worth less than a dollar in your pocket right now. The second tool is a bit more down to earth. It's often called the comparables method, or comps. Instead of trying to predict the future, you just look around at what similar companies are worth today. So you might take a number like EBIT, which is just a fancy way of saying operating profit, and see what multiple of that profit other similar businesses are trading for. If companies just like yours are trading for about 9.9 times their profit, well, that gives you a pretty good ballpark for what you might be worth too. So we've gathered our clues, we've used our tools. But wait, here's the final plot twist in our investigation. A company's value isn't just some number sitting there waiting for us to find it. The people running the company, they're actively trying to change that number every single day. So, the really crucial point here is that managers are constantly making decisions that can pump up a company's value. And one of the most powerful levers they can pull is deciding how much money to borrow. Using debt, what the pros call leverage, can be a really powerful way to supercharge the returns for the owners. And here's a perfect example of how that leverage effect works. Let's say a company makes a 10% return on its investments. If it's only using shareholders' money, well, the shareholders get a 10% return. Makes sense. But now, what if the company borrows money at, say, 4% interest and invests that to also earn 10%? That extra 6% profit it made on the borrowed money, it goes straight to the shareholders, boosting their total return. It's a great way to amplify value, but of course, it adds risk too. You still got to pay that debt back. Whew, our investigation has taken us all the way from the nitty-gritty of financial statements to the big picture ideas of risk and reward. And what we found is that a company's true value is this complex dance between its performance, the risk it takes on, and the strategies it uses. Which leaves us with one last big, provocative question. We've just spent all this time learning how to calculate intrinsic value, which, let's be honest, is a complex estimate full of assumptions. But the stock price, that's a simple fact. You can look it up in a second. So, which one is the real truth? Well, that's a mystery every single investor has to solve for themselves.